Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market update: Geopolitics, PPI data, and tech sector analysis, June 11, 2026. This video presents a direct informational narration of the source document. All right, let's dive right into this explainer. The source document paints a picture of a really wild day of intraday market reversals, all driven by some intense geopolitical events. It notes that the U.S. military conducted what they termed additional defensive strikes within Iran. Now, because the market had already digested this negative news with a sharp drop the day before, equities actually tried to mount a pre-market rebound. Nasdaq futures were briefly up over 1.2%. But that rebound was quickly interrupted. The president posted a threat stating that if Iran didn't sign an agreement, severe strikes would happen that very evening. This threat included seizing Karg Island and other key oil infrastructure to essentially control Iran's oil and gas market, drawing a direct parallel to actions taken in Venezuela. Naturally, this sudden escalation caused index futures to drop right back down in the short term.
So, here is our agenda for this explainer. First, we'll look at macro data and conditions. Second, diplomatic resolution. Third, strategic geopolitics. Fourth, sector liquidity. Fifth, AI infrastructure capex. And finally, corporate updates.
Section 1. Macro data and initial market conditions. Following that pre-market geopolitical roller coaster, the release of the May Producer Price Index, or PPI, further squeezed any futures gains. U.S. PPI for May rose 6.5% year-over-year, which is actually the highest increase we've seen since November 2022. The month-over-month increase of 1.1% also beat expectations, largely driven by energy prices and rising transportation and warehousing costs. Now, looking at the core data, which strips out food and energy, core PPI rose 4.9% year-over-year. That's a bit lower than the expected 5.4%. The month-over-month core figure of 0.4% also came in just below the anticipated 0.5%. But here's the crucial takeaway the document stresses. The widening gap between the Consumer Price Index and the PPI is really putting corporate profit margins under pressure. As production costs rise faster than consumer prices, companies are the ones absorbing these costs right now. The analysis notes that while this is sustainable in the short term, these costs are eventually going to be passed down to consumers, which definitely raises the risk of secondary inflation. And this domestic inflation data perfectly aligns with a much broader global narrative. When you combine this with the previous day's CPI, it's clear inflation is accelerating. The energy price hikes stemming from the Iran conflict are really piling up, making inflation suppression the absolute top priority for the Federal Reserve and severely limiting their policy flexibility. And we're seeing global central banks respond too. On that exact same day, the European Central Bank announced its first rate hike in nearly 3 years. This was a direct response to a Eurozone inflation rate that pushed past 3%, well above their 2% target. With oil price shocks getting worse, the source notes a widespread market expectation that major central banks are going to adopt hawkish monetary stances, including an expected rate hike from the Bank of Japan next week. Under all these heavy macro conditions, it makes total sense that the Nasdaq entered a sideways consolidation right after the open. Section 2. Diplomatic resolution and market reversal. But then, everything shifted. According to the document, at exactly 1:30 p.m., a massive diplomatic breakthrough hit the wires. The president announced that consultations with Iran had been submitted to and officially approved by Iran's leadership. Because of this, those airstrikes and bombing plans scheduled for the evening completely canceled. The announcement did clarify that the naval blockade would temporarily stay in place until the deal was absolutely finalized, but the agreement itself was in its final stages. It's actually expected to be signed this weekend over in Europe with the vice president attending. And once that happens, the Straits of Hormuz will be fully reopened. The market's reaction to this 1:30 p.m. news was frankly explosive. The source contrasts the morning's pre-announcement environment, which was full of panic selling and spiked oil prices, with a massive post-announcement surge in buying volume. Talk about a whiplash, right? The Nasdaq ended up closing up 2.54%. The S&P 500 and Dow Jones completely reversed their earlier losses to close higher, while WTI crude oil futures absolutely plunged. And semiconductors, they led a huge, broad technology rally. But the source document highlights a really interesting underlying institutional motivation for this violent rally: the SpaceX IPO scheduled for Friday. The analysis suggests that major Wall Street institutions had a very real, fundamental motive to stabilize the market and ensure liquidity ahead of this massive public offering. These afternoon diplomatic developments successfully pushed the S&P 500 right back above its 5-day moving average. Section 3. Strategic geopolitics and Karg Island. Let's look a bit closer at the specific geopolitical levers mentioned.
The document details the strategic asset of Karg Island. This place is the hub for roughly 90% of Iran's oil exports. The analysis notes that while a U.S. ground occupation of the island would mean huge troop deployments and risk high casualties, an aerial strike on the infrastructure presents a much lower tactical barrier. Destroying it would completely cripple Iran's funding. But here's the interesting part. The source emphasizes that during previous large-scale airstrikes, the energy infrastructure on Karg Island was intentionally left intact. Preserving it acts as the ultimate financial leverage. By threatening Karg Island in the pre-market, the U.S. was essentially issuing an ultimatum, applying maximum pressure to force those diplomatic concessions that finally materialized in the afternoon. To give you an idea of how tense things were getting, the CNN Fear and Greed Index had plummeted to a severe low of 26 earlier that morning. It had seen a steep drop over the past week, falling from a neutral 53 straight down to 26, literally cut in half. This metric perfectly reflects the severe liquidity constraints and panic the market was enduring right before the SpaceX listing. Adding even more to this geopolitical puzzle, the source text relays claims from the president that the U.S. military had actually been running secret missions since last month. These missions were apparently assisting oil tankers in bypassing Iranian control in the Strait of Hormuz. Following the destruction of certain Iranian radar installations, vessels reportedly slipped through at night with over 100 million barrels of oil successfully evading the blockade. Now, the source carefully notes that this specific 100 million barrel figure remains independently unverified, but U.S. Central Command did officially confirm that commercial shipping is currently continuing through the strait.
Section 4. Tech sector liquidity and hardware demand. Shifting gears from macro geopolitics to specific tech liquidity, the source document examines the Magnificent 7 ETF, ticker symbol MAGS. These tech heavyweights faced intense selling pressure, seeing at 11% drawdown from their early June peak. That wiped out nearly half of their gains since the March low. However, the document attributes this decline directly to institutional liquidity clearing, rather than any deteriorating fundamentals. To prep capital for that massive SpaceX IPO, institutions were selling off highly liquid, large-cap stocks like Nvidia and Tesla, using them strictly as a piggy bank for liquidity generation. With this short-selling momentum now largely exhausted, the text suggests these oversold equities might see a big return of capital once the SpaceX listing is officially in the rearview mirror. While the broader software and mega-cap names dealt with those liquidity drains, the demand for hardware is still absolutely roaring. The document highlights a really severe memory chip supply constraint. Western Digital, for instance, shot up 14.5% to a brand new all-time high. Supply chain data shows that as NVIDIA's next-generation Rubin graphics cards hit mass production, the global memory market is facing some serious deepening constraints. Major cloud providers are aggressively booking long-term capacity agreements, literally reserving supply out to 2027 and 2028. Because of this, the supply-demand gap for DRAM and NAND is expected to widen even further in the second half of 2026, which is going to keep memory prices elevated for at least the next 2 to 3 years. Section 5. AI Infrastructure CapEx and DEC. Now let's talk about the cost of all this AI infrastructure. The document uses Oracle as a prime example of the massive financial burden carried by these heavy asset builders. Oracle's equity dropped 8.5% following its earnings report, completely halting its rebound right at the 50-day moving average. This was driven by capital expenditures heavily exceeding expectations and a brand new required financing plan. Get a load of these numbers. Oracle is facing a projected negative free cash flow of $23.7 billion in fiscal year 2026 and a staggering $70 billion in planned capital expenditures for fiscal year 2027. To fund this, they have to raise $40 billion through debt and equity refinancing. Oracle now carries approximately $117 billion in total debt. That is massive. That makes them the largest bond issuer outside of the entire financial sector. The source text actually draws a really fascinating parallel here between the current AI data center build-out and the infrastructure frenzy right before the 2000 dot-com bubble. Back then, companies like Cisco and WorldCom completely overbuilt fiber optic networks. That overcapacity eventually caused bandwidth prices to collapse by over 90%, which obviously crushed those infrastructure companies. The document argues that today's AI data centers share 3 high-risk business traits: heavy assets, high leverage, and rapid depreciation. Because NVIDIA chips iterate roughly every single year, the speed at least these assets depreciate actually outpaces their ability to generate a return. The current profitability in AI infrastructure is just due to a temporary compute shortage. The text warns that once supply finally catches up to demand, highly leveraged data centers are going to face some extreme financial pressure. And Oracle definitely isn't alone in this high-leverage environment. The source points to AI compute provider CoreWeave. They recently announced plans to issue $3.5 billion in senior notes just to refinance their existing debt. Their total debt burden has reached an eye-watering $35.1 billion. The company's stock has dropped 30% since the beginning of the month, and it's currently holding on to a technical support level at $91 per share. If it fails to hold that $91 line, the document notes the stock's technical formation will break down completely.
Section 6, Corporate Updates and Contracts. Let's wrap up with some specific corporate updates. Amazon, which is obviously a massive cloud buyer driving a ton of this AI capex, is showing much stronger fundamentals compared to pure data center entities. The document notes Amazon just disclosed a new $17.5 billion loan facility led by Citi. Furthermore, they announced their entry into the less-than-truckload, or LTL, freight service market. This disruptive entry immediately impacted traditional LTL carriers. Shares of Old Dominion Freight Line actually dropped about 5%, slashing its market value in a single day. Meanwhile, Amazon's own stock is up approximately 58% year-to-date, trading right near its all-time highs. Over in the alternative energy sector, the document reports that Bloom Energy's stock took a hit following news that a data center initiative known as Project Jade had been suspended. This suspension was initiated at the request of the customer, though their identity hasn't been disclosed. This is a big deal because the project developers had a power purchase agreement with AEP Energy, which was directly tied to a solid oxide fuel cell supply agreement with Bloom Energy. So any disruption in this chain directly impacts Bloom's future revenue expectations.
Finally, the source text notes that Teradyne secured a huge $140 million fixed-price contract from the U.S. Air Force. This contract is to provide multifunctional diagnostic automatic test set suites. This absolutely solidifies Teradyne's position as a key supplier in the defense technology market, and it injected the stock with enough momentum to surge 10%. So, looking at all of this, from volatile global diplomacy to massive debt-fueled AI infrastructure builds, how long can the tech sector balance this incredible hardware demand against the reality of tightening global liquidity? That's the question we all need to be watching.